Hi, everybody. My name is Zach Wilson, and welcome to Self-Directed IRA Saturday. I'm one of the IRA specialists here at Quest Trust Company, and I'm really excited for today's class because I think we're going to be covering a topic that not too many people really know how to navigate, right? When we're in a market in the condition that it is in today, both on the public side and the private side, it's something that not a lot of people have experienced, right? So I think moving forward in an intelligent way with all the factors to consider is something that's definitely a big topic that can help out a lot of people. But before we get started, got to give you the disclaimer. So everything that you're about to see here is for your educational purposes only. It's important to understand the role that Quest will play when it comes to your retirement investments. We're here to really facilitate all the transactions that you would want to do within your IRA and offer as much education and as many resources as we can to both our clients and investors. But with that being said, Quest does not offer any sort of tax, legal, or investment advice, nor do we endorse any specific investments. So, for those of you who aren't really familiar with us, we are Quest Trust Company. We're the largest self-directed IRA custodian in the state of Texas. We have roughly 20,000 active investor clients all across the country. We have over 2.7 billion in assets and under administration, and we're hoping that number keeps growing. Right now, we have over 100 employees, 36 of which are certified IRA service professionals. What does that mean? That means when you give us a call, not only are you not going to get an answering machine, you're going to get someone who's going to answer the phone and be able to answer just about any questions that you can have. And if you want to take a deep dive into the nitty-gritty stuff, we have 36 certified IRA service professionals there to take that dive with you. And as it stands right now, we have over 400 million in undirected cash sitting in our clients' accounts. Now, that represents opportunity, right? Whether you're part of that current Quest pool or you're an investor that needs capital to make your deals happen, this is where your opportunity lies. Now, before you make any sort of investment, before you take the first step at all, you have to educate yourself. So please utilize us as a resource at this point. Check out our YouTube channel. Check out our website where we have our education center. We have tons and tons of videos going over just about every aspect of investing when it comes to your self-directed IRA. Right, we're going to have videos introducing you to simply what the idea of self-direction is and give you the kind of breakdown of what the rules are surrounding the accounts that you're now working in. And then we've got videos all the way in the other spectrum talking about the more complex topics of things like UDFI, syndication, stuff like that. So please utilize us as an education resources before you're making any investments decisions. But once you've nailed down the investment that you're looking to pursue, it's not going to make itself happen, right? So the next step is going to be your networking. All right, please again utilize us as a resource for your networking events. All right, check out the classes like you're doing right now that we host every single Saturday. All right, come to our lunch and learns that we have on the first, second, and third Thursday of every month in our Houston, Austin, and Dallas offices. All right, those lunch and learns are going to be at noon, and we have a presenter come out going over any given topic, and you get to have face-to-face conversations with people within the Quest network. Also, check out our virtual networking happy hour. That's the national networking happy hour that we have on the fourth Wednesday of every month, starting at 6:30. This one is strictly meant for networking. You get to come on, you get to introduce yourself, what you like to do, and what you're looking for. All right. And this gives you a chance to connect with other Quest clients that otherwise couldn't make it to the Houston, Austin, or Dallas events. And so they're going to join the networking happy hour. We even had people join as far away from London, all right, which is a pretty cool experience. I got to be a part of that networking happy hour. But by far the most common networking event that we have is going to be our self-directed IRA socials. All right, these are going to be on the first, second, and third Tuesday of every month in our Houston, Austin, and Dallas offices, respectively. They start at 6:30 on those Tuesdays. And how it works is we allow for about 30 minutes of networking, after which we have a presenter come out. They're going to go over any given topic for about 45 minutes. After that, we allow for more networking and then deal pitching. So if you're someone who has a deal lined up, you're looking to raise capital, or you're simply someone who has money to invest and you don't know where to put it, you just want to let people know that you're looking to lend out of your IRA, here's a perfect opportunity to do that because it's both an in-person and an online event, right? So even if you don't see someone in there, there could be someone watching that's interested in partnering with you. All right. Now, if you have any questions at all, please reach out. We'll be happy to help. You can receive my information below. Reach out to any one of the IRA specialists. We can answer just about any type of question that you could have, right? And be sure to take advantage of the promotion that we're running right now, our Texas two-step. All right. So what it is when you first establish the account, you do get charged a $100 open account fee. But if you move over 5,000 or more before tax filing deadline, we're going to credit your account back $125. So essentially, you're going to end up getting that account for free as long as you move over that 5,000 before tax filing deadline. So like I said, today's topic, I'm really excited. Sorry about that, guys. So I think this is something that is very, very important to a lot of people, and not too many people give it enough weight, right? They don't realize that the strategies that you're using now in the market and the condition that it is in today, it should be different than how it was 5 years ago, right? So this is something that a lot of people need to educate themselves on and how to update their strategy. So without further ado, I want to bring on Mike Zlotnik to come on and introduce himself. Mike, you there?
Hi, Zach. Hi, everybody. Appreciate being on this live event. Been working with Quest for many, many years. Love working with you guys. You are the best of the best. So I'm honored and humbled to be of service, and definitely excited to talk about how to invest with downside protection in this recessionary environment. So let me bring up a few slides, and then we'll kind of start running, and then we'll jump into Q&A. Does that sound good?
Sounds good.
Hope you can see this.
Yep, we see it. Perfect.
Thank you. Let me run through. I have a lot of slides, hopefully a lot of great information. I'm going to go very fast, and please hold your questions to the end, and hopefully you learn a lot. So wonderful disclaimer. This is for informational educational purposes. I don't give advice, nor we offer to sell anything. Provide no warranties, and consult with your attorney, CPA professional before making any investment decisions. So this is our team, Tempo Family of Funds team. We have great folks, and we are geographically spread all over the country, including Texas. So let me start by just talking a little bit about the economy. This is not particularly new information, just an executive summary. So inflation is slowing down, although it's very stubborn. Unemployment is very sticky. It's difficult to fight unemployment. We saw 3.4% print in January. It's very difficult to curb the inflation without getting unemployment to a higher number. This is just an old concept called the Phillips curve. To make long story short, we need to get unemployment to a higher number before we can actually get inflation completely under control. Government spending has slowed down, obviously, and there's a broad expectation of recession for the second half of the year. This is just a high level. Risk light is on. This is a really important concept from the point of view that interest rate is a indicator of risk, and the interest rate has gone up rapidly. I call it too fast and too furious. The Fed had pushed the rates up, and it takes a long time for the result of their action to actually be seen in the economy. It's called long and variable lags. Fed action has long and variable lags. It's actually gotten pretty difficult to value assets in the uncertainty of this environment. So future underwriting got harder. Cost of capital obviously has gone up, interest rates. And we don't know what's going to happen. Is it going to be soft landing or a series of rolling recessions? What we do know is distressed deals are coming, and they're going to be both in debt and equity side, and there will be really interesting opportunities to come. We just don't know when and to what degree. Huge pressure point is brewing in the economy. Very important point. So it's a fundamental point. A lot of real estate deals and non-real estate deals, just corporate America, has borrowed cheap money in the past few years. When the Fed maintained ZIRP policy, zero interest rate policy, for years, many loans have been taken as an example here, 3.5% rate, and these loans mature, and now they need to be renewed. And you can see what happens with payment factor when you borrow the 3.5, and now you have to pay 6.5. It's a gigantic pressure point, and the result of this is that many real estate sponsors and operators will be dealing with a problem. They're going to need more cash to be able to service the debt on the loans, called debt service coverage ratio. So they'll have to raise additional capital from existing investors, go to new investors, or sell a property. And the sale of the property might constitute great opportunity, or the fact that they don't have enough cash to pay the bank may turn properties into distressed sales with a bank taking the asset or agreeing to some kind of a short sale. So great opportunities could be coming as a result of this pressure point. Anyway, so understanding 2023 opportunities, you're going to see distress and discounted deals. As I mentioned, result of high interest rates, rate cap expiration. So rate cap simply means you could have gotten a variable rate mortgage, but you bought a rate cap insurance. And when the rate cap expires, your rate shoots up as a result of that expiration. Asset underperformance will create greater opportunities, and some projects just run out of cash. They can't complete their value add work. All those factors will generate opportunities for the fresh capital to come in, and it will come in two forms. One is called rescue financing. So fundamentally solid assets, but they're short on liquidity, short on cash. So we've already seen this. We've already done deals in this environment, providing essentially rescue financing in the form of mezzanine debt or bridge debt to help sponsors finish their projects and bring them into the market and sell in orderly fashion instead of a distressed sale. So these deals could exist in the form of mezzanine debt, bridge debt, preferred equity, or full equity recapitalization. For some of you, these may be fancy terms, but these opportunities in commercial deals present absolutely great risk-adjusted return. We'll love them. We're already starting to see some, and we expect a lot more coming later in the year. There will be new deals. That's the sort of option number two. If it's not rescue financing, it'll be a new deal financing, and it will be purchasing distressed assets from the seller with the bank approval or even bank taking over completely. And these are the great opportunities that we, as fund managers and capital allocators, are looking at where the best return on investment will take place and where the downside protection will exist. So I'm going to run through a couple of basic concepts. One of the most important point of this presentation is downside protection actually comes from diversification. And you might love roller coaster rides, and so much more power to you, and enjoy roller coaster ride. I prefer smooth sailing. Smooth sailing is achieved by virtue of a diversified portfolio. The reason this is important is that before you write a check, you have to think about how does it fit into your diversification strategy. Investment quadrants. So this is a concept that we developed years ago. We continue to use it. It's a very powerful educational concept, and it helps investors, you understand where you're putting your capital. Are you putting your capital in risky deals, so we call them speculative grade deals, or you're putting your capital in more investment grade? These deals have downside protection. We'll cover downside protection mechanism. This whole presentation is about investing with downside protection. So quadrant 1 and 2 are basically deals with downside protection, and they're called investment grade, and quadrant 3 and 4 speculative grade. Quadrant 1 and 3 are cash flow focused or income focused, and quadrant 2 and 4 are growth focused. And there are deals that fall into different quadrants. I want to run through the stuff very quickly. If you want to learn more about investment quadrants, reach out to us. We have a lot of educational content on the point, but this helps folks make decision where they want to place their money, especially if they're concerned about risk. And one important point that many deals fall between the quadrants, something to keep in mind. Some deals fall between quadrant 2 and 4, some deals fall between 1 and 3, and some between 1 and 2. Just something to keep in mind that some deals are easily in a given quadrant, some deals are in between. Please remember, all projects have risk. No matter where you write your check, you have to be mindful that there is a risk. The only things that don't have risk essentially investments in theory in the government treasuries, but even those have some level of risk. As we all know, government is a little dysfunctional, and they're struggling with the budget, and if they don't approve increase of the debt limit, the government could theoretically default on its debt too. So in investing, the holy grail of all investing is a risk-adjusted return. All this means is that as you invest, you need to think about potential losses. So when you take on more risk, the loss reserves have to be a little bit higher. And any offering documents, whether you invest in a fund, syndication, or partner with people, there's always a risk, and the projections may or may not hold. And it is important you as an investor always prepare for some level of a risk, and that's what loss reserves cover. Anyway, investment grade deals generally have substantially lower level of risk and so lower loss reserves, and speculative grade deals, the deals that take more risk, need substantially higher loss reserves to deal with the problems when they happen. Another really important fundamental slide is that you want to build your portfolio that'll last through various market cycles. And we'll talk about portfolio goals, very, very important component of it. Beyond that, as an investor, you can allocate your capital into different investment quadrants and decide how much risk you want to take. And then one of the other most important concepts in this presentation is you can build your portfolio with building blocks. And there are essentially 4 building blocks in real estate. You have funds, you have syndications, you have partnerships, and you have individual deals. And you have to make decisions how much capital you want to put in diversified funds, concentrated funds, single strategy funds, single asset syndications or partnerships, or individual deals. Here's an example of portfolio building goals, your risk tolerance. If you don't sleep well at night and you don't tolerate risk, you should not be writing a check in speculative deals. However, if you're young and you feel comfortable with a higher level of risk and a higher upside potential, you can live with it. Again, your portfolio goals includes cash flow goals, total return goals, tax efficiency, diversification, time horizon, liquidity. For an IRA investment, generally speaking, you don't need to worry about tax efficiency, but it's something to consider if you invest in cash. Again, investment quadrants and your portfolio allocation. Generally speaking, in a recessionary environment, I personally prefer to write bigger checks, more dollars flowing into quadrant 1 and 2 and less into quadrant 3 and 4. There's no right or wrong. It depends on the individual situation. But as you can see here in this portfolio example, you can have 50% quadrant 1, 30 in quadrant 2, a little bit in quadrant 3 and 4. This portfolio is a little bit more defensive in nature, although it can vary for different folks. Just an idea that you make the decisions where you want to deploy your capital. This is a planning exercise. Before you write checks, you should know at least where you're going, what are you trying to build. How do you determine what quadrant a given deal falls into? And it takes experience to understand this and to figure it out. But obviously, portfolio or a fund strategy, what is an individual deal life cycle? What are the downside protection mechanisms? What kind of cash flows? What is the projected return? What is the projected risks? And then the structure of the deal or a fund. How senior are you on the capital stack? Are you in primary debt? Are you in the secondary debt? Are you participating in a preferred equity or common equity? How much leverage? What kind of fee structure? And what is the fund manager or a sponsor track record, the expertise, integrity, ability to communicate, ability to solve problems? All those things matter in determining where a given deal falls into. Think like Warren Buffett. So this is as fundamental as it gets. Investing is always about people, actual decisions, which deals you're going to write your capital into, and then how much capital you're going to deploy. So Warren Buffett does it a little differently. He decides which companies to buy, who is going to run those companies, and what amount of dollars to pay for those assets. For us, it's all about people we invest with first. Who are the fund managers? Who are the sponsors? Who are the operators? Because their ability, the integrity, their capabilities, the experience matters. And then obviously picking the investments that fit your overall diversification, your asset allocation, your risk profile, and so on and so forth. And then obviously how much capital to invest. Now, we're going to go into the crux of this whole discussion, how to invest with downside protection. And really, number one priority, in my view, is to pick the people, the conservatively focused fund managers and operators and sponsors, and build, know, like, and trust. It's very difficult to write a check with anyone who you don't know, like, and trust. It's almost a requirement. But this is, by the way, one of the major benefits of self-directed investing. Why you working with Quest? Why are you working with us? Why are you working with folks like us? It's because you actually can get to know people that you're investing with, like, and trust them. In contrast, if you're investing in Wall Street, you would be investing in 40,000-pound gorilla, some kind of a large REIT or a large company stock, and it's very difficult to meet the executives. So it's one of the major differences. You can actually have control and ability to communicate with folks you invest with on a personal level. Number two is diversification. Can't state this enough, because what you'd like to do is to build a portfolio that will last and can withstand recessionary downturn. So it's something to keep in mind. Diversification is one of the most important risk mitigation strategies and one of the strongest elements of downside protection. And priority number 3 is selecting, obviously, the deals that fit you in your risk tolerance. And in a down economy, in a recessionary environment, focusing on quadrants 1 and 2 is, generally speaking, a way to go. Although you can invest in quadrants 3 and 4 if you are comfortable with the right level of risk, and if you have a high conviction that you're getting into strong deals, even though they have more risk, but they're the right deals for you to take the risk on. Real important example, you could lose money. This is the essence of investing. Deals do go wrong. And something to keep in mind, one of the fundamental issues, do I invest in a diversified fund? Do I invest in a single strategy fund or a single deal? Well, this will present you a picture of what happens when a deal goes bad. And the reason it's important is there's a rule: don't lose money. Of course, you can lose money, and it will happen from time to time. But having the ability to minimize losses is critical. So when you invest, when you write a check into a diversified fund and the fund has 30 assets, you spread the risk and your exposure to a single deal is only 3.3%. With a single strategy fund or a little more focused fund, you have a little greater exposure. But if you write one check into one deal, that deal goes bad, unfortunately, you could lose the entire capital. The same is true on the other side. When the deals go well, when they do well, you can get a greater return at single asset deal versus diversified funds. But the funds smoothen the journey. They don't have the same jumps up when things are going well, and they don't fall the same way when we are in a recession. And we're going into a recessionary environment. This is why this concept is very powerful and very important. Anyway, factors impacting return volatility. So return volatility, I hope you understand the idea. If you're looking to generate 10% a year on average over many years, you don't want to have years where you lose 20% and years where you make 30%. What you're trying to do is smooth the journey and minimize these ups and downs. So return volatility obviously depends on the quadrant, and quadrant 1 and 2 have lower volatility than quadrant 3 and 4. Market cycle. Typically, during an expansion, volatility is lower. During contraction or recession, volatility is higher. And diversification. The broader you are diversified, the less volatility you're going to experience. So here's volatility examples. Diversified funds are a lot, they generally could have a much lower volatility. So in example, a diversified fund could have 10 to 13% target. In a great year, it makes 25%. In a bad year, it loses 10%. If you go single strategy fund, and we've seen this, by the way, in the COVID, hospitality industry or some elements of office have taken it on a chin in a big way during the right after COVID. Some of them recovered well and some have not. So volatility on single strategy funds could be high depending on a fund. And in single asset syndication, we've seen in our experience returns actually exceeding over 150% in a year. And in a bad year, you could lose all of it. So volatility can be really high in single asset syndication. Anyway, here's an example of portfolio. This is not even an answer. It's a question to you. Do you prefer a portfolio built with more funds to build that diversification and some syndications? And then you can also do it in the reverse direction, where you do fewer funds and more syndications or single asset deals like a loan. So this is going to give you a little bit of a perception of how you can build a diversified portfolio. Now, income investing with downside protection, very important concept. We're focusing on quadrant 1. So you can have diversified funds, some of them focused on first lien debt, some conservatively leveraged common equity, some preferred equity. Some focus strategy funds could fall into this quadrant as well, some single asset deals, syndications, partnerships, or single asset loans, for example. When you are investing in the fund, one of the most important concepts is to ask fund manager, what is in the fund? Can I see the portfolio? Can I get a good understanding? And one of the important elements is you're not looking for a perfect portfolio. If you're going to see perfect portfolio, maybe that's a concern. Normally, seasoned, mature funds do have some deals that are doing great and some deals that may be a little underperforming. Just an example to think about, but definitely get the details so you have an idea what you're investing into. Here's an example of the quadrant 1 deal, first lien performing note. So Quest is great at this. We've seen this done, I don't know, millions of times, where you want to loan the money, on a conservative loan, and Quest will facilitate. You make a loan from your IRA. And generally speaking, you're looking at conservative valuation. Loan to value ratio of 65% or better, ideally 60%. Strong borrower, clear plan, some kind of 12 months or less duration, and you want to charge an adequate or market appropriate rate of return. One of the benefits of rising interest rates, that the rate you can charge on your loan, this is a sort of a hard money loan, has actually gone up. So in the past, for example, you could charge 9%. Now you could be charging 11, 12%. That's actually a benefit from the high interest rate environment. So this is a very important slide. It shows your capital stack, or at least an example of a capital stack. And you make a decision as part of the downside protection. Are you comfortable with only senior debt, maybe mezzanine debt, which is secondary debt, preferred equity, or are you investing in the common equity? And the downside protection is built by understanding what you're investing into and where you're investing in a capital stack. This whole presentation about downside protection. So understanding who you're investing with. As I said, people first. Second, what's your strategy? Are you investing in distressed assets, distressed and discounted assets, where your entry point is a great entry point because you know something is worth $100 and you're investing at $70. You're getting an intrinsic value. You're getting a discount. You're paying a price lower than the value you're getting. And then you also can choose defensive asset classes. For example, in the recessionary environment, in general, multifamily and storage and a few other asset classes are considered to be more defensive. Office in today's environment is almost a cursed word. It's doing bad as a result of the COVID, but also we're going to recession. Office is going to get hurt. So you get to make your picks and choices. Where do you want to put your dollars with the downside protection? Obviously, capital structure. Are you investing in mezzanine debt, primary debt, preferred equity, or common equity? All that matters. Location, where you're investing into. Some markets are known as cyclical. Some markets are known as non-cyclical. Some markets have done really well. For example, Texas has been a growing market for many years. So there's a Sun Belt, generally speaking, Florida, Texas, where there's inflow of dollars, inflow of folks moving from northern states because of the better tax environment, more business-friendly environment. However, you could choose a non-cyclical market in the Midwest and do just as well, where volatility is pretty low. And obviously, deal fundamentals. Let me continue running. So preferred equity could also be very attractive as one of the ways to participate in these deals with strong upside and strong downside protection. So obviously, as I mentioned, high quality sponsor matters, good track record, good communication, high integrity. Obviously, the deals to have downside protection need to be light or moderate from a value add perspective. You don't want to get involved with a hairy deal with a lot of risk associated with super heavy construction. There's a lot of risk involved with development and redevelopment. Those deals generally don't fall into quadrant 1 and 2. They fall into quadrant 3 and 4. And a preferred equity, if you're participating in preferred equity, you actually want to see good amount of capital behind you in the common equity. So all those things make a lot of sense. And if you're investing with downside protection and for income, you need to see some distributions. So preferred equity could actually see distribution yield, and here's an example of 8%. And you may have total preferred equity of 16, but the distribution is 8, and the other 8 deferred until there is a capital event like refinancing or sale. And obviously, you want to make sure that if you are in preferred equity, you're behind primary debt, first mortgage, then that primary mortgage should be conservative. 70% is an absolute max. You want to see ideally 60% as a way to put you in a stronger position. And some other requirements, strong debt service coverage ratio, and fixed rate interest or some kind of rate cap in place. Just an example of what a preferred equity deal could look like. There are common equity deals that could be in quadrant 1. And there are a broad range of possible asset classes. So this is just a high-level description. In general, to be a quadrant 1 deal, you want to see light to moderate renovation, obviously some value add, decent cash flow from day one. I'm using an example of 4%. In this environment, when you're investing in equity, it's gotten harder to get cash flow because the debt interest rate has gone up. So mortgage is consuming more dollars, more cash. That's why the cash from cash returns have come down. Nonetheless, you can still have a quadrant 1 deal. Obviously, light fees, strong sponsor, and some kind of a good pref and a split. This is an example of a common equity deal that could still fall in quadrant 1. Now, if you're considering to invest in quadrant 2, which is basically investing for growth with downside protection, you should think about deals with less leverage, minimal or low leverage. Non-performing loans is a great opportunity. You can actually buy a defaulted note at the conservative loan-to-value ratio, and then foreclose on that note. It's a strategy that falls into quadrant 1. It's a growth strategy. You're not getting yield today, but you're well downside protection at the conservative loan-to-value ratio. And there are some syndications in quadrant 2 that have strong protection elements on the downside, but they don't cash flow. The big difference in quadrant 1 and 2, quadrant 1 has cash flow, quadrant 2 doesn't have a cash flow, but they both have strong downside protection elements. Anyway, as I mentioned, non-performing loans could be, and the upside on these non-performing loans, you're not collecting 9 to 12%. You're collecting a high default rate. Example is 18 to 24%. This is the reason you would consider investing in this type of deals. It could be a value add syndication, like I showed before, quality cash flow syndication, except for it's got a value add component and its cash flow is minimal or a break-even cash flow. So it still has downside protection elements, but it needs a year or 2 of improvements, renovations before you're going to see the cash flow. And if you're not in dire need to get distributions today, you may be comfortable to invest in a project like this. And deals that have downside protection must have strong liquidity to withstand delays and other issues. Anyway, this is an example of quadrant 2 deal, what I call a moderate value add deals, typically break even or better cash flow. What you're looking at is renovations on turn, not a lot of forced vacancy. If it's a multifamily project, leverage with good debt, fixed rate debt, adequate capital reserve, strong risk-adjusted ROI. So you need to pay attention to the underwriting and fundamentals. But these deals do fall into quadrant 2, and they provide downside protection. Just a quick summary. So if you think about downside protection in a recessionary environment, these are the key components. Invest with people you know, like, and trust. Diversify, diversify, diversify. As much as you can, you almost can't go wrong on over-diversifying. The only downside of big diversification or strong diversification is you will have a lot of assets to manage. One of the ways to mitigate that risk or that difficulty is you invest in diversified funds who diversify for you. Focus on quadrant 1 and 2. You certainly can look at quadrants 3 and 4. And obviously, set your expectations conservatively. If you're looking for whatever target return, in your head, you need to discount and adjust for risk. Everything has risks, so set conservative expectations. That's about it. And happy to answer any questions. If you want to learn more about investing with downside protection, feel free to reach out. And our primary website is tempofunding.com. Also, I'm available through bigmikecall.com and bigmikefund.com.
Awesome. Thank you, Mike. So let's go and get started. Guys, also for everyone viewing this, please take advantage of the chat, right? Ask as many questions you have. We're now going to start the Q&A session. And really, you're going to get out of this what you put into this. The more questions you guys ask, the more information we're going to be able to convey with, as we go along. So, Mike, to get started, since we're focusing on downside protection in a recessionary environment, kind of briefly tell us about what that looks like within the real estate market, right? What does it look like to be in a recessionary environment within the real estate market?
Sure. So the presentation covered a little bit of this. So your downside protection is derived from many dimensions. One of them is obviously diversification, as I mentioned. Second one is, what do you invest in? If you invest in first lien debt, that is downside protection. If you invest in some kind of preferred equity, has element of downside protection. You also get to pick and choose where you invest into, location. Who do you invest with? What type of asset class? Multifamily storage, as I mentioned, have a greater downside protection in a recessionary environment versus office or shopping or hospitality. Those industries generally take it on the chin. Some take more on the chin, some take less on the chin. So as you're looking for recessionary protection elements, is all the things that I mentioned. It's not a single thing, it's multiple things. So you're picking obviously the people who are running diversified funds, who are running portfolios that are focused on downside protection. And you're picking the regions of the country, you're picking strategies, you're picking where you are on a capital stack, how comfortable you are. And what's really interesting right now, as risk hit, transaction volume in commercial real estate has fallen substantially. So right now, it's kind of a very interesting time. On one hand, the buyers would love to get these great deals, and they're looking and they're salivating for phenomenal opportunities to invest. The sellers, at the same time, are not capitulating. So we are in this weird time where the transaction's taking place, but at a much lower value, and everybody's gearing up for something more exciting for them. Buyers for better deals, sellers are still hoping they're going to sell at a good price. So you as an investor, as a capital investor, probably need to align yourself with the buyers and think more conservatively, look for better deals. And it takes time, experience, and energy to be able to identify what is a good deal. One of the most important questions that I ask, and we look at a lot of deals. I'm a fund manager. This is what I do day in and day out. As I look at deals, my first question before I get to hear a deal, and we don't have any cold pitching. We don't ever talk to people who we don't know, like, and trust as is. We're getting them from the network. My first question to them is why it's a great deal. Explain to me why this is a good deal, why this is not an average deal, but this is a really strong deal. And of course, every deal is different, every strategy is different, but these are the questions that we're asking to basically get comfortable before we write a check.
Okay. And so, and knowing that we are in a bit of a market that inflation is higher, right, and the Fed is working to counteract that by increasing interest rates. Historically, how have different property types performed during times of high inflation like this, in which we are seeing, what people would argue is already a recessionary economy?
Sure, so it's a great question. I mentioned this. So there are a few asset classes that are pretty well known to be great hedges against inflation. At the same time, they do well during a recession. So hedges against inflation, storage does really well. Multifamily does well, especially affordable housing multifamily. And I'm going to stress this out. There's some high-end multifamily, and there are great high-end condo developments. I certainly don't think those are ideal for this environment. Much better hedge against inflation, affordable workforce housing. So these type of projects are very interesting and exciting. There's a shortage of affordable housing. And where does affordable housing come from, right? And it's not easy to get these projects developed. Most developers write checks into more attractive asset classes. So in the affordable housing, you pretty much have Class C, Class B multifamily. A's get too expensive in general. You get some really interesting strategies that we've seen post-COVID. For example, conversions of hotel to affordable multifamily housing. Now, these are smaller units, but they're definitely more affordable. So just an example. As I mentioned, storage generally does well enough. Industrial could be a strong defensive class. What is a lot more exposed and carries a higher risk, and I mentioned this before, I'm just sort of reiterating this, is I would stay away from office. In my opinion, it's just a lot of risk. It's both combination of COVID and the general recession. Hospitality is at risk. Some level of shopping could be at risk too. But what's a great hedge against inflation are the things I mentioned. They just work in general when there is a inflationary pressure. So think about it this way: multifamily, there's a shortage of affordable housing. The rents continue to go up with the rising costs. And something really interesting happens. As interest gone up, the cost of buying a house has gotten higher. The affordability, the mortgage payment has gone up. So affordability to buy has gotten a lot worse. So what do people do? They substitute. They still want to live in a nice area, so they're forced to rent. So when they're forced to rent, the demand for rent increases. That's why multifamily housing, typically good quality Class B assets, benefit the most from this increased interest rate environment through the substitution effect. Storage generally does pretty well. because storage you're renting month to month. With inflation, the rents could easily be pushed up, and ability to adjust the rents, not necessarily on a monthly basis, but on a quarterly basis, is fairly easy. So those are the asset classes that I believe do generally well during high inflation environment.
Well, thank you for that, Mike. And so we've got Rom asking a couple questions in here, asking, is it truly a down market right now? Are we in a recession? And I guess a question you kind of just answered, asking just, is it a good time to buy single family? Knowing that a lot of real estate investors kind of, when they first get introduced to the idea of investing into real estate, it's usually through single family homes, right? Whether it's fixing and flipping or rental properties, right? Is now a good time in your opinion? And obviously, every situation is going to be different, right? A good deal is a good deal, depending if the numbers work. But in your opinion, right now, is it a good time to buy single family homes?
Sure. So let me answer the first part of the question. Are we in a recession now? And the answer is absolutely not. We're not in a recession. The reason for that, you can't have a recession with unemployment rate being 3.4%. It's almost impossible. We're certainly, the economy is still cranking on multiple fronts, but there's a risk of recession in the second half of the year. That's kind of a general concession. So we're not in a recession yet, but there's a fear, uncertainty, doubt the recession is coming. As far as buying single-family residential today, the answer to the question, it depends. Are you getting a good deal? Are you getting a great deal? So if you can justify the price you're paying based on long-term fundamentals, cost of construction, the comparable properties in a given area. If you got a distressed sale situation and you're able to acquire at a great price, absolutely. But if you're paying full retail price and you're getting higher interest rate mortgage, your cash on cash may be negative, in fact. So you just have to be mindful how much cash on cash it will generate. Are you getting fixed rate mortgage? What it's going to cost you? It is a hedge against inflation, in a manner of speaking. But your cash on cash, most likely in this environment, unless you get a distressed and discounted deal, will be zero or negative or very, very slight cash flow. So if you're investing as a hedge against inflation, maybe worth considering. And if you're getting a good deal, personally, the other element to consider, and I own a portfolio of turnkey properties, of these single-family residentials, and I've experienced the following. There's nothing fundamentally wrong against that investment. Just have to know that if you build a whole bunch of them, you have a whole bunch of little investments. And if you have 50 houses, you have 50 assets to manage. So from my perspective, I personally gravitated to more commercial deals because they're easier to manage. They have economy of scale. However, there's nothing fundamentally wrong. America is built on single-family residential housing. So if you get a good deal, you get a good mortgage, you're comfortable with the cash flow, why not?
Awesome. So with us being in this recessionary environment, we're going to move on to the next question on how can people protect themselves and their investments in a recessionary environment? I'm sorry, project themselves, right? When you're making projections as far as your portfolio. And I think this goes back to kind of what you had presented with your 4 quadrants, right? How does the split among those 4 quadrants differ in an environment that is expansionary versus a recessionary environment?
That's exactly correct. You have to look. You know what's most important? What we're doing today, we have lots of investments in our funds. We are looking at every asset we own in every fund. Where does it fall? What quadrant? What are the risks? So you can actually look at your own portfolio, look at your own investments, and determine where do they fall, what quadrant they fall into, how downside protected are they? Is there a risk that you can lose money on the deal if the interest rate resets, the loan matures, and now it's a much higher interest rate, or there is an economic recession and you could lose money on the deal. So I'll give you an example. Office investments that you wrote a couple of years ago could be suffering today with lower occupancy than before because of the COVID, right? And you have to prepare, is this project going to survive or going to go under? Or you may have great deals that are just doing phenomenal. You invested a few years ago at a great price. Now the rents are up, inflation has pushed the income up, you're enjoying higher revenues, and you feel strongly about that. So just analyzing your portfolio, what quadrants it fall, what percentage of your portfolio falls into each quadrant can give you a decent idea how exposed you are to potential downside of a recession.
All right, thank you. And so let's look at the chat. There's a couple of people asking questions. We'll start off with Looks like Leticia saying, I'm currently looking to buy a storage facility. I currently have about 90K plus with Quest. Am I better off taking my lump sum out, cashing out, or should I just borrow from myself? Please clarify. So obviously we can't give you sort of tax, legal, or investment advice, right? You have to be sure we're only offering education. Mike, could you point her in any direction as to what the things to consider is when when answering this question?
So if I understood you correctly, you want to buy a facility. You could theoretically buy the project into your self-directed IRA. You could use Quest as the custodian, and you can make the investment from your Quest into the project. Now, I don't know the size of the project and what kind of debt leverage, what kind of mortgage you're going to get. But I can't give you any advice. But taking distribution from your IRA, paying taxes on the distribution, and then investing in cash, I think it's a worse idea than actually investing through the self-directed IRA. Again, consult with your own CPA. But if you found a great deal, that's the beauty about working with Quest. You can actually buy the asset into your self-directed IRA instead of buying it in cash into your LLC. So that's a power of a self-directed. And I don't know if Quest does what is known as a checkbook IRA, where you have an LLC that is owned by your IRA, and the LLC can buy the asset and get the mortgage. So it's another option.
Yeah.
That, again, does Quest allow for these type of deals where an IRA owns an LLC?
Absolutely.
Yeah, so there you go.
Yes, we absolutely do. And Leticia, he's exactly right. So best thing to do would be check with your CPA, right? Figure out what the tax implications of both decisions are. And then if you're looking to pull the trigger within your IRA, give us a call, speak to an IRA specialist about what exactly that process would look like. And like Mike said, we do offer that checkbook control IRA, so that could be an option for you. All right. Next question is from... Let's see, it's Rom saying that the GDP has decreased 2 successive quarters. Isn't that the definition of a recession?
Yes, that is a technical definition of recession. I don't. There was 2 quarters of negative GDP, if you remember, about a year ago, and that was a technical recession, but it didn't really materialize to take place on a longer term basis. So the GDP alone, that indicator, is not sufficient. Yes, technically you could say 2 negative quarters, negative growth quarters symbolize the recession. But practically speaking, we need to think about what is happening to the unemployment, what is happening with consumer spending. So there are many practical data points that really describe a recession. The fact that GDP shows 2 negative quarters doesn't necessarily mean it's a big problem. So something to keep in mind: there's a recession, right? There's a light, mild recessions that feels like a breeze, and the asset prices don't really decline, and it feels like, boy, that's not a big deal. And there are situations where recession turns into severe. So just keep in mind that hitting a technical mark, this is now a recession by definition of 2 negative growth of GDP quarters, doesn't mean it's a severe recession. Unemployment, in my view, is a gigantic indicator, and most real recessions need unemployment number to be somewhere 5% plus. We are 3.4%. We're still pretty far away from a substantial recession. Can things turn to a negative rapidly? They could, and that's what people are fearful about. But right now, the January print of unemployment was 3.4%, and it doesn't feel like a recession with that low unemployment.
Thank you for that. And so the next question is from Rick Garrett, saying in the past several years we've seen pretty good price growth in housing, especially in Texas and Florida. Do you expect prices to stay flat, drop down, or still show slower growth than in the next 1 to 2 years?
That's a crystal ball question, and I have a wonderful answer for this. I used to have a crystal ball; it broke. I can't find another one for sale. Right? We don't know that. These are future events, highly speculative, uncertain. In general, the trend have been growth in Texas and Florida, although some markets overshot and overheated. So I will provide a word of caution. It depends where, right? So I've seen this where the pricing, including Florida, some of it is already correcting, and some in Texas too. I know for a fact certain parts of Boston overshot, certain parts of Florida overshot, simply because the markets are great. On a long-term basis, absolutely bullish on Florida and Texas. However, on the short-term basis, there may be some corrections in some markets because prices overshot in these very hot markets. So short term, be careful. Long term, still very bullish.
Awesome, awesome. And so, knowing that a lot of people with the condition of the public market are kind of turning towards alternative assets, and people just getting started don't exactly know how to tackle specific deals, and so they're turning to real estate funds. So without going in too much into your specific fund, because obviously we have to keep it educational and broad, can you tell us a little bit about how private real estate funds work?
Sure. So happy to talk about this. This is what we do day in and day out. We run Tempo family of funds. We have an income-focused fund, a growth-focused fund, and an income and growth-focused fund. In general, these funds are private funds. They're offered through Regulation D, and we're offering our funds under 506C. These are accredited investors only. Now, there are other technically offered, there are some Reg A plus funds, but in general, these private funds function as following. You have a bunch of investors, many investors, and then the capital gets raised into the funds, and the funds deploy into many assets. They spread the capital across many investments. And there are what I call diversified funds. Well, this is what we do. We diversify among many dimensions of diversification. We diversify among different sponsors that we invest with, different asset classes, as I mentioned, multifamily, storage, industrial, so on. Different locations around the country. So they have multiple dimensions of diversification. So that's diversified strategy funds. There are focused strategy funds, or I call them single strategy funds, that are, for example, first lien debt only in certain markets, only, for example, Texas or Sunbelt, or Pacific Northeast, or Pacific Northwest, or Northeast, or Midwest. They're specialists in their own local markets, and they're specialists in a given strategy. There are also funds that focus on a strategy like self-storage. And then folks that focus on the strategy might have assets in many markets, but that's all they do. There are multifamily funds, there are shopping plaza funds, and so on. So again, many investors, many investments, that's what the funds do fundamentally. And there are single deal syndications where it's not a fund, it's still many investors participate in the deal, but it's a one asset acquisition. And that's the big difference between the funds and syndications.
Awesome, awesome. And so, does anything change, especially, I guess, speaking to now on your end, when you have someone looking to invest into your fund that is investing personally or with their entity versus investing with a self-directed IRA? Is there anything that kind of changes on your end?
Sure. So in general, all our funds are IRA friendly. And as an IRA investor, and again, without giving any advice, you have to also understand what you're investing into. Are you investing for income? Are you investing for growth? And by the way, this is true for cash too. You have to know what strategy you're going for and what's your time horizon. There are funds that what are known as open-ended funds, where you could subscribe and then you can redeem in 2 years. So they have redemption period, they have a lock-in period. Our open-ended funds subscribe and redeem every quarter, and they pay distributions every quarter. And there are closed-ended funds. Closed-ended funds typically raise capital from investors for a certain amount of time, and then they invest for a certain duration, for example, 5 years. So you need to understand those things before you even write a check. But as far as IRA versus cash, there are certain funds that provide great tax efficiency. So they provide depreciation benefits. And depreciation benefits are of little value for IRAs, and they are very valuable for cash. And there are certain funds that generate no or limited tax benefits like depreciation, and they're perfectly suited for IRA. So there's no right or wrong. It depends on what source of money, what kind of strategy, what quadrant you're investing in, your level of comfort. You may be willing to take more risk with cash and less risk with IRA money because you feel that it's more valuable. It's your retirement money. So depending on the personal situation, decisions vary. So our funds actually offer multiple options. We have preferred units in our funds and common units. Preferred units are generally a lot more interesting to the IRA investors, and the common to cash, as I mentioned. So it depends on the individual situation, the source of money. And as I mentioned, time horizon, risk tolerance, cash flow versus growth, all those things matter. Hopefully that provides a little bit of color.
Yeah, absolutely. And so I want to shift a little bit now to specifically focus on notes. Right now, in the condition of the market, what is the benefits of investing into notes right now versus going into single family homes, multifamily, whatever it is, right? What is it? Kind of what are those benefits about note investments right now?
So the primary benefit of debt investing or notes is higher interest rate environment. So as the interest rates have gone up, theoretically speaking, you should be able to get a higher yield in your note. I'll give you some examples. We just did a deal where we provided promissory note, first lien loan, to a borrower. So the loan was $1.5 million with a collateral of at least $2.5 million. It's a commercial building. So we basically wrote a first lien mortgage, first lien note on a property with the loan to value ratio of at least 60%. It said 1.5 million divided by $2.5 million value, that's 60% LTV. And what's interesting is in the past, we would be charging a yield of 12% for this type of product, 2 points, 12%. Right now, we were able to do 2 points and 14%. Interest rates have gone up, so we are able to charge high interest. This is one of the major benefits of this environment. Why consider doing notes? You can probably get a little bit higher yield that you were able to get a couple of years ago. Of course, you can participate in equity too, but put yourself on the equity side. The big difference is if you are an equity investor, and previously the mortgage was 3.5%, and now it's 6.5%, your debt service has gone up a lot. We're talking about bank money now, right? So as an equity investor, your cash on cash has shrunk a lot versus what was a few years ago. So your cash flow is lower. So if you're looking for cash flow, note investing looks a little more attractive because you're getting high interest rate, as long as you obviously underwrite conservatively. But if you're participating in equity, you have to be prepared that your cash flow will be lower, and you generally demand a better price to buy because your cash flow has gone down. So at a better price to buy, you could still invest in equity. And that's kind of the tug of war, depending on are you getting a great deal or not. But in absence of a great deal, we all naturally gravitate to what we're just discussing right now, writing first lien mortgages, writing sometimes second lien mortgages. More, it's a little more risk, obviously, but if you're comfortable with the underwriting profile, to give you example, we underwrote a rescue capital in distress situation into a deal that was running out of cash and didn't have enough cash to finish the construction, to take the property to the market at the normal sale. And we did second lien. This was late December. We charged 2 points and 15.5% rate. So higher rate, obviously, because second lien. A few years ago, we'd be charging 14. Today, it's 15.5. So if you can underwrite well, you can get a higher yield. That's the biggest lesson.
And what should people be considering when note investing, right? What types of due diligence should be done?
Well,
and obviously that's a wide question, but I guess if there's any commonalities, right? Because obviously, whenever you're investing, it depends on what are you investing with, right? And what's the collateral and stuff like that. But I guess as far as wide-reaching due diligence, what should be the consideration?
As I mentioned previously in the presentation, I'm a big fan of diversification, and I can't stress it enough, right? There are good diversified first lien mortgage funds. So if you are considering to invest today, should I do a single note or diversified fund, just consider diversification as a way to mitigate risk. If you can underwrite well yourself, you have experience and you feel comfortable, it's a process. And the underwriting, and we do quite a bit of investing from our funds. Our funds mix multiple strategies, including writing first lien debt on some of these projects. Always underwrite the borrower first, know, like, and trust, capable, good balance sheet, good financials, good credit, all that stuff, right? Second, you underwrite the asset, where it's located, its condition, if it's a commercial property, tenants, if it's a single family residential, what the rent looks like. Obviously, risk to the property, is it well maintained, and that's an underwriting box, and you need to have it. You need to develop it. If you're going to do deals on your own, you need to get very comfortable with underwriting these deals. Commercial deals are harder to underwrite than residential. It takes time and experience, and one of the ways to shortcut that is to invest into a fund that does this and actually listen to the quarterly calls and bother the fund manager as an investor and say, hey, how did you underwrite this deal? How did you underwrite that deal? Ask for the details. So don't just invest, but invest to learn. This is one of the best ways to put it. I like to correct this question. Whenever you thinking about learning and investing, are you investing to learn or learning to invest? You always need to have both. You're trying to do two things at the same time. Sometimes lessons will be painful if you make mistakes. You learn a whole lot more from mistakes than from successes. But there is no school. Well, I'm sure there are classes how to underwrite commercial and residential loans. But it's a process. It's a process over time.
Okay. And so there's a couple more questions that we've hit our hour mark. So let's just kind of speed through the last bit of questions that are in here. Christine and Christopher and Corey Waters asking if we're headed towards a recession, which one, unemployment rate increasing or the Fed increasing interest rates to 8 to 10% would happen first? Otherwise, why wouldn't inflation continue to rise?
Wow. These are gigantic numbers. So 8 to 10% unemployment is a severe recession by many definitions. And the Fed pushing the rate 8 to 10% means massive inflation, right? So I am, this is a crystal ball question. And I don't know for sure, but I do believe that the U.S. Inflation over time will come down. It is coming down already. And with the interest rate where it is, I don't think Fed needs to be pushing the rate to 8 to 10%. They're almost done. They'll probably push the rate up another 50 basis points and they'll be finished. So going to 8 to 10% is, in my view, highly, highly unlikely. And that 8 to 10% Fed rate, they could put the economy into recession that deep, that severe, that we would see unemployment rate 8 to 10%. So which could come first? Well, I don't think either one will come first. At least it's not a likely scenario. But if the Fed overshoots and they overdo, and they often do overdo it on the interest rates, they may start seeing unemployment rate picking up to the point where it's not going to be 8 to 10%. They'll probably stop when they see, and they reverse the direction, most likely start easing when they start seeing unemployment rate probably at some point above 5.5%. I don't think the tolerance for severe recessions is gone. So we've all gotten accustomed to the government stepping in or the Federal Reserve stepping in. So I don't see 8 to 10% Fed funds rate, nor do I see unemployment hitting that, at least not in any foreseeable future.
All right. And then Brian Gambino has a question asking now recession definition is subjective versus objective, like was decades before, what's the new technical definition? So I guess just, and correct me if I'm wrong, Mike, but that technical definition has been there for a while, right? But whenever we're agreeing that the economy is in an overall recession is when it is widely impacting everyone, right? Like you said, a year ago, there was a technical recession that wasn't nearly as impactful as we're feeling that what might happen in the second quarter. Kind of 2 quarters of GDP decline is kind of just part of what is the overall life cycle of the economy, right? Versus when we're in a recessionary portion versus an expansionary. And so, Mike, I guess, did you have anything you kind of wanted to add to that?
Yeah, I would say that the technical definition is important, but who cares? What cares is how those people feel. And when they're beginning to see consumer confidence falling, the producer confidence falling, the credit card debt increasing, concentration of spending on necessities and much less on discretionaries. These are the general kind of conditions of a recession. And obviously unemployment increasing. And of course, GDP will turn negative. If you move combination of those things happening, you will have a negative GDP. At that point of time, we'll probably have Fed stepping in and trying to ease again and trying to stimulate. So it doesn't even matter what the technical definition it means. What matters more is how people feel and how the economy just operates in general. That's, at least to me, it's more important than did we hit technical 2 quarters of negative GDP. And remember, that 2 quarters of negative GDP is a trailing indicator. The leading indicators are the consumer confidence and how much debt they're carrying on credit cards and so on and so forth.
All right, and then final question, we'll do the last one before we'll go, is Mike asking, how do self-directed IRAs work on the tax side for Tempo Fund investments? How does it accommodate for complex Tempo Fund K1 as a tax pass-through? Does the K1 need to be processed the same way for after-tax money? And so I guess I'll start. I'll let you go and kind of how you guys issue your K1s, and then I'll give our side of what to look for within the self-directed IRA.
So it's a great question. It's a complex question. It's going to be, I'm going to try to give you high level. Yes, most of our funds provide K1. So these K1s come out and they go to your CPA, and most of the times the answer will be consult with your CPA if there's a potential of any UBIT. Generally, our funds use no leverage. So our funds, non-leverage funds, although we do invest in some assets with leverage, and as a result, there may be some potential risk for UBIT. Some investments in our funds have absolutely no UBIT risk because they invest in debt instruments. So we actually have classes of units that do nothing but invest into certain strategy, and the strategy is actually all debt. So as interest income generated, that should produce no UBIT. They're also part of what we offer. We offer some syndications, and syndications that offer debt investments. We call them debt units. These debt units have no UBIT risk for the reason that's interest income. And interest income in general is not subject to UBIT. So we've got a lot of IRA investors who participate in our funds. Also, I mentioned we have preferred equity, which acts like that, quacks like that, looks like that. And we have many IRA folks investing into those preferred equity units to reduce the risk of UBIT consideration. As far as my years of experience, and I'm not giving tax advice, we've never had a situation where IRS came in and they said, well, you were in preferred equity and there was some leverage with some of your investments. As a result, there should be some UBIT risk. A lot of people concerned about UBIT, but something to keep in mind that the risk of an audit of an IRA, and again, Zach, you know this better than I do. I spoke with Quincy, your founder and CEO, years ago, and you can count number of IRA audits on one hand. It's that small. It's not, the IRAs don't get audited. And so many people overthink UBIT risk.
Yeah.
Gray area. Some investments could theoretically trigger some UBIT, but there are millions and millions of people in the country that are in 100% UBIT risk situation when they buy a house into an IRA with a mortgage debt leverage. And when they sell a house, this is 100% subject to UBIT. They don't pay UBIT. Again, I'm not advocating tax avoidance or any of that stuff. I'm just saying I've seen this again and again and again. So we provide K1s. Our funds don't have fund level leverage. Some of our investments have leverage. Theoretically, is there some risk of UBIT? Yes, possibly.
Yeah.
Some investments have zero risk, as I mentioned, debt investments that we offer as part of our syndications, or some preferred units within our funds. I hope that clarified the picture a little bit.
Yeah, and like I said, it is a complex topic, right? We're in that gray area of UBIT. Specifically, we're talking about debt leveraged investments. We're talking about UDFI. That's kind of subsection of UBIT that the IRA would usually run into in this situation. So, Mike, for your next question, asking if you can completely ignore the K1, don't ignore it, right? We don't necessarily need you to send it to us every single time, but that K1 is definitely going to be used, right, when you're going to work with your CPA, and know that whenever you're opening up the IRA to potentially UDFI taxation, you're also opening it up to deductions, right? And that's where that K1 is going to be useful. If you can claim any sort of depreciation, any sort of deductions related to knock down the taxable income that your IRA is experiencing, that's where you're going to leverage that K1. So don't ignore it. You don't have to bring it to us. Save it, hold on to it for when it comes time to potentially run into UDFI, and that's where you're going to utilize those.
Right. Yeah, and I'll just one quick color. Of course, consult with your CPA, right? We use very high caliber CPA firms, very capable. They produce those K1s. And if you are in doubt, have your CPA reach out to our CPA. I mean, there's just no other way. We're focused on getting you great return. As a fund manager, am I thinking about tax efficiency? Of course we are. Nonetheless, our primary goal is to invest prudently, right? And if we generate great return, and your IRA may theoretically have some subject of UBIT risk, You may make actually a decision with your CPA. Say, hey, theoretically, there's some UBIT risk, but you may choose not to file, or you may file and just pay a little bit of tax and be done with it. So there are some strategies, advanced strategies that you can utilize with your IRA if you're really nervous about investing with UBIT. You could set up a blocker C corp. It's this idea. It's an advanced topic.
Right. So
Literally, if you're not comfortable and you want to sleep 100% at night, you have your IRA own a blocker C corp, and the C corp can always pay whatever necessary tax.
yeah, and it's paying at the corporate level versus at that UDFI, at that trust rates. So that's definitely an option. There are other solutions to UDFIs, guys. And if you want to kind of look into that, give us a call. We IRA specialists are very knowledgeable on UDFIs when it comes on UDFI when it comes to self-directed IRAs. Not something to be worried about, just something to be aware of, right? The most common investment we see here at Quest is multifamily syndications, and a lot of them bring on UDFI to our clients, right? So I guess at the end of the day, you're always going to want to consult with your CPA to make the best decision for you. But all right, we got to wrap it up. We're at an hour and 11 minutes. Mike, thank you so much for coming out and talking to us about this. Like I said, I think this is just something that is incredibly important for people to consider going forward, making their investments with the market and the condition that's in now.
Zach, thank you kindly for your gracious invitation. Appreciate the opportunity to be here.
Absolutely. And guys, that's Mike's information. Reach out to him if you got any questions. If you have questions geared towards your self-directed IRA, give us a call at Quest. We'll be happy to help you. But until then, everyone have a good weekend.